Very good morning, all of you. Now, we are going to consider here in this period the financial goal, profit versus wealth maximization. It means that objectives of financial goals are those. What are the objectives of the financial goal? First objective you will find profit maximization, and second objective you will find wealth maximization. Okay, such type of a classification is broadly done in these two classes. Now we are going to consider here now what is the meaning of profit maximization. Maximum profit to be earned by the organization. Try to understand. The maximum profit to be earned by the organization in a given period of time. This is the objective of profit maximization. The term denotes the maximum profit to be earned. Okay, the maximum profit to be earned by the organization. The profit maximization goal implies that, try to understand, the profit maximization goal implies that the investment, financing and dividend decisions of the enterprise, those should be oriented to the profit maximization. Try to understand. Maximization of profit can be defined as maximizing the income of the firm and minimizing the expenditures. A firm can only make profit if it produces goods or delivers the services at a lower cost. It means that whatever may be cost of the production is there and whatever may be the cost of the delivery of the services is there, that cost should be lower. Okay, should be lower. It is seen that the firm which tend to make profit eventually makes use of its resources in a more efficient manner. Profit is regarded as a parameter to the measures of the firm and its productivity and efficiency. The company can lower its cost and increase the sales to earn more profit. Without profit, it is very difficult to survive in the market. If the company earns good profits, then only it can manage to serve the society in the large run. Okay, it means that profit maximization, that is also a most important aspect of the business finance. Okay, try to understand. It means that profit, this is the main object to earn a profit by any organization. This is the main objective of the profit maximization. It means that such type of a firm try to lower their cost and more increase their sales. Automatically, if cost of production or cost of sale is lower, cost of the sale is more, then your sale will be more. Okay, and if sale will be more, your profit will be more. That's why this profit maximization principle you have to understand in detail. Okay, now what are the objections of profit maximization? If any company is going to earn maximum profit, at that time also certain objections are can be raised there by the society also. Try to understand what are those objectives, and those objectives or those objections, different types of the objections are created there for the profit maximization. First objection, you will understand, in order to earn more profit, companies form monopoly. This is the first objection. If any company is going to earn more profit, at that time also the society or the people of the society think about that the companies form monopoly in this market. This is the first objection. Then second objection we have to understand, employees are also forced to work more than their capacity. It means that whatever may be capacity of the employees are there, those capacities or beyond that capacity also they are going to work there. That's why employees are also forced to more work. Employees are also forced to work more and more and more than their capacity. Then third objection is also we have to understand, manufacturers produce goods which of less use of the society and create artificial demand. It means that whatever may be use of the society is there, that use of the society manufacturer should consider. But this is not happening elsewhere. Okay, manufacturers produce goods which of the less use of the society and create artificial demand for their goods and services. Such type of objection also we have to understand. Then next objection we have to understand, ignores the risk factors and tries to maximum the profit. It means that such type of organization always and always ignores the risk factor, and that organization tries to maximize the profit. It means that risk factor is going to ignore and profit is also going to maximize. Such type of objection we will find. Okay. Then next objection is also there. Emphasis is generally on short run projection. Emphasis is generally on short run projects. It means that such type of projects are there and those projects are short run projects. Okay, but not a long run projects, but should have to think about the long run project. But any organization do not stress on long run projects, and such type of objection is also taken on profit maximization. Then in the new business environment, profit maximization is regarded as a unrealistic, difficult and inappropriate. It means that in case of new business environment, such type of things are inappropriate, such type of things are unrealistic, such type of things are difficult, and such type of objection also we have to understand here. Okay. Then second we have to understand, that is a wealth maximization. What is it? Wealth maximization. Maximization of market value of the firm's share. Okay. It means that the main objective of the wealth maximization is, try to understand, the main objective of wealth maximization is to maximize the market value of the firm's share. It is maximizing the net present value of the course of the action to the shareholders. The net present value of course of action is the difference between the present value of the benefits and the present value of its cost. It means that cost and benefits, present value of cost and benefits, the difference between that is called net present value. A financial action that has a positive NPV, okay, creates wealth for the shareholders. A financial action resulting in the negative NPV destroys shareholders' wealth and not a desirable. The objective of wealth maximization considers the timing and risk expected benefits. The benefits are measured in terms of cash flow. Try to understand. Maximizing the shareholders' economic welfare is equivalent to the maximizing the utility of their consumption over time. The wealth created by a company through its action is reflected in market value of its share. Thus, market value serves as the company's performance indicator. The concept of wealth maximization ensures the economic interest of its stakeholders. It also aims to achieve and fulfill the social and economic obligations upon the business. Okay, it means that wealth maximization is also, we have to understand here, like as a profit maximization. Now, what are the objections against wealth maximization? Those objections also we have to consider here in detail. First objection is taken there, it ignores short-term economic benefit. It means that when any organization giving stress on wealth maximization, at that time that organization ignores short-term economic benefit. Then second objection is also taken there, it ignores unstable share market. Okay, whatever may be instability is there in share market, such type of instability is also ignored by the such type of organization. Then another objection is also taken here, it creates conflicts, it creates conflict of interest between management when management is separate from the ownership. It means that there may be possibility of conflicts between management and ownership also, if there is a management separate from the ownership. It means that such type of conflicts can be possible there, and such type of objection is also taken here against wealth maximization. Then next objection also we have to understand, that is it may be lead to extra benefit to the management. It means that management used to earn extra benefit. Okay, and such type of objection also have to understand. And the next objection, that will be the last objection, it may not be suitable to new organization. It means that wealth maximization is not suitable to the new organization. In this way, these are the 5 objections against wealth maximization are there. Now, we have to understand the comparison between profit maximization and wealth maximization. With the help of the different points, those points also I have given in this chart. Okay, in the column number 1, different points are given. With the help of those points also, we can differentiate between profit maximization and wealth maximization. Try to understand. Now, what is the difference between profit maximization and wealth maximization? First difference we have to study here according to the financial goal. In case of profit maximization, what is the financial goal? To earn a large amount of profit is the financial goal of profit maximization. And in case of wealth maximization, what is the financial goal? To improve the market value of the company's share. Try to understand. To improve the market value of the company's share, this is the financial goal of the wealth maximization. It means that in this way you can write the difference between profit maximization and wealth maximization with the help of this financial goal point. Okay. Second point is also given here, emphasize. In profit maximization or profit maximization refers to short-term objectives of the company. Try to understand. Profit maximization refers to short-term objectives of the company. It means that emphasis is given on short-term objectives of the company. And in case of wealth maximization refers to not short-term but long-term objectives of the company. This is the difference between profit and wealth maximization. Then with the help of third point also we can differentiate these two aspects. What is the third point? Risk and uncertainty. In case of profit maximization, the concept profit maximization ignores risk and uncertainty. In case of profit maximization, it means that the concept profit maximization ignores risk and uncertainty. What about wealth maximization? The concept wealth maximization recognizes risk and uncertainty. It means that in wealth maximization recognizes are there and here ignorance are there. Okay, this type of a difference you can write there. Then fourth point is also given here about the time value. Profit maximization ignores the time value of the money. Try to understand. Profit maximization ignores the time value of the money and wealth maximization considers the time value of the money. And the last difference we can explain here with the help of the advantages. Profit maximization goal acts as a yardstick for computing the operational efficiency of the business unit. But in case of wealth maximization, goal has an advantage of gaining a large market share. Okay. In this way, these are the 5 points. With the help of those 5 points, we can differentiate between profit maximization and wealth maximization. Now, what are the routine financial functions? We have to understand. What are the routine financial functions of the business? Those financial functions also we have to understand here. Routine financial functions are performed under the supervision of the financial manager. Who is responsible for such type of functions? Financial manager is responsible for such type of financial functions. They are carried out by the people at a lower level. These functions include the following tasks. It means that what are the routine functions and what tasks are also included, those also we have to study here. First task is there, supervision of cash receipts and payments. This is the first task. You have to make supervision. Such type of a financial manager has to make supervision or has to supervise the cash receipts and cash payments. Then second task is also there, custody and safeguarding cash balances and valuable papers such as securities, insurance policies, certificates to the contracts, etc. Such type of papers should be kept in safe manner. And this is also another important function which is included in routine financial functions. Okay. Then next function is also given there, that is taking care of mechanical details. Taking care of mechanical details regarding all new outside financing. Taking care of mechanical details regarding all new outside financing of the firm. Then next function is also mentioned here, that is maintaining record of the firm's activities. Each and every activities conducted in the firm, record should be maintained about those activities which have financial implications. Okay, and this is also routine financial function. Okay, and the next function is also given here, that is a timely report to the facilitate financial manager. Timely reporting, that is also essential, and to facilitate to whom? Finance manager. And this type of routine function is also we have to understand. Then relationship of finance we have to understand. Relationship of finance with other areas of managers. Okay, what are the other areas of management? There are three areas of management. First area is production area, second is marketing area, and third is personal area. Now we have to understand what is the area, what is the production area. That production area also we have to understand. In a manufacturing concern, production activities can be carried out smoothly provided necessary finance are available. Finance is needed right from the purchase of raw material to its conversion into finished product. Try to understand. The financial position greatly affects the decisions regarding production activities. The investment in plant and machinery and other equipments, the investments in plant and machinery and other equipments needed for production involves financial decisions. The level of inventory is of special significance as far as finance is concerned. Okay. The overall efficiency of the production department depends upon timely supply of finances. If any financial department is making timely supply of finances, at that time that department is efficient department. It is called efficient department. In this way, the finance area and the function of production area we have to study here. Then second function is also given here. Second area is also given here, that is a marketing area. The success of business depends upon marketing of the products and services. For organizing marketing activities on a large scale, try to understand, financial provision has to be made. The credit and collection policy of the firm has a great impact on financial position. The marketing strategy has financial implications since funds are locked up in accounts receivable. Market research, sales promotion, advertising, and publicity of the company's products can be handled efficiently if necessary. If necessary financial backup is there. In this way, marketing area, this is also second point we have to understand, second areas of the management. And the last area of the management we have to understand, that is a personnel area. A personnel area plays a key role in organization. The decisions regarding wage bills, allowances, monetary and other benefits given to the employees entirely depend upon the financial position of the business. The staff welfare activities have the great bearing on the finance of the company. Thus, it can be seen that business finance is closely related with all the functional areas of the management. In this way, these are the different types of the areas of the management which are related with financial manager. Now, finance functions. What are the finance functions we have to understand? The functions of raising funds, investing them and distributing earning. Try to understand. The functions of raising funds, investing them and distributing earning are known as financial decision, investment decision or dividend decision. Okay. These three types of the decisions you have to understand. Then a firm has to attempt to balance Firm has to attempt balance between cash flow and outflows properly. Cash inflows and cash outflows properly. It means that there should be balance between cash inflow and cash outflow. Then next function also we have to understand routine finance functions performed under the supervision of financial manager. They are carried out by the people at a lower level. These functions include the following tasks. What are those tasks? First task is their finance function. In that finance function, you have to take decisions. And first decision we have to take investment decision. What is it? Investment decision. The investment decision comprises decisions relating to the investment in fixed and current assets. Mostly it involves capital expenditure. Try to understand. The investment proposals are to be evaluated in terms of expected return and risk. The finance manager has to evaluate the various investment proposals and select the best. Okay? He has to fix the criterion for evaluating the options on the basis of priority and availability of funds. Further, you have to understand future benefit of the investment cannot be predicted with certainty. Investment in current assets depends upon the credit and inventory policies. The fixed assets investment depends on the long-term goals of the organization. It means that first financial function we have to understand, that is investment decision. Second financial function we have to study here, that is finance decision. What is the meaning of finance decision? Finance decision is the second important function of the business finance department. Okay, it is not decided where from and how to acquire funds to meet the investment needs. The finance manager has to identify the sources from which funds can be raised. He has also to ascertain the amount that can be raised from each source and the cost involved. The main issue here is to determine the appropriate proportion of equity and debt capital. The mixture of debt and equity capital is called capital structure. Try to understand what is the meaning of capital structure. The mixture of debt and equity capital is called capital structure. The capital structure is said to be ideal when the value of share is maximized. A proper balance has to be kept while issuing ownership and creditorship securities. It means that such type of decisions also you have to take, and those decisions are called financial decisions. And third type of decision we have to study here in this topic, that is a dividend decision. Dividend decision is the third major financial decision. Try to understand. The management has to decide the proportion of the distribution of dividend. The percentage of profit to be distributed to the shareholders depends on the dividend policy. The decision also depends on number of other factors such as earnings, taxes, profitable use of funds and market price. A good dividend policy is one that maximizes the market value of the firm's share. Theoretically, the dividend decision depends on whether the company or shareholders can make more profitable use of the funds. In this way, this type of decision is also we have to understand. In this way, the financial functions are divided into three classes. First, investment decision. Second, financial decision. And third, dividend decision. Now, such type of decisions also affects on such type of dividends are also affects on the size of the business, the growth of the business, the profitability of the business, risk of the business, and of course the value of the business. It means that such type of decisions, three types of the decisions we have studied, and those three types of the decisions can affect on these five aspects. Okay, then we have to understand these such type of effects, and those effects you have to study. In this way, after considering such type of effects on the decision or decision affects on these five aspects, What are those 5 aspects? First aspect is size of the business. Second aspect is growth of the business. Third aspect is profitability. Next aspect, risk, and the last, value. In this way, these are the effects. These are the decision effects of the business. Okay. In this way, with the help of these five points, we have completed this point. Okay. Thank you. Thank you very much.